Welcome to the Long Game Podcast, where we don't just talk numbers, we decode the stories behind them. Today, we begin a journey into one of the most misunderstood ideas in investing. It sounds like a simple question, maybe even a boring one. Earnings versus cash flow. Which one should you trust? But behind that question lies a trap that even professional investors fall into. Because if you answer it wrong, if you trust the wrong number, you could fall in love with a business that looks like a gold mine on paper and turns out to be quicksand. Let's open with a real story. It's the year 2001. Enron is the darling of Wall Street. The media calls it the most innovative company in America. Analysts can't stop recommending it. Its earnings are growing like wildfire. But behind those beautiful earnings, there's no cash. Enron reported billions in profits, but its cash flow statements quietly told a different story. A story of mounting debt, hidden liabilities, and financial engineering so complex it needed entire off-balance sheet entities to hold it all together. Investors who trusted the earnings and ignored the cash got wiped out. This isn't just history. It's a warning. Because the game hasn't changed. The names have. Let's fast forward to 2022. Netflix, yes, Netflix, reported billions in net income. On paper, profitable. But if you looked at their cash flow statement at the time, you saw red ink. The company was burning billions in cash to create original content. Yes, they were growing. Yes, they were dominant. But their profits were based on accounting rules, not actual cash in the bank. Does that mean Netflix is a fraud? Not at all. But it does mean you can't stop at the earnings line. You have to dig deeper. Now, let's flip the script. Look at Amazon in the early 2010s. Their earnings? Paper thin, barely profitable. Some quarters, not profitable at all. Critics laughed. They're selling at razor-thin margins. But what was their cash flow doing? Growing, strong, steady, and climbing. Amazon was reinvesting cash into logistics, technology, and scale. They weren't losing, they were building. And those who understood that, who followed the cash, not the earnings, they saw what was really happening. Amazon wasn't weak, it was a fortress under construction. That's the power of cash flow. It reveals what earnings can hide. Because earnings are crafted. They're built according to accounting rules that allow companies to delay expenses, estimate future profits, capitalize costs, and smooth things out. Sometimes that's reasonable. Sometimes it's dangerous. But cash doesn't lie. You either got it or you don't. When Warren Buffett looks at a business, he doesn't ask, how much did they earn last quarter? He asks, how much cash did they actually generate from operations? That's the real test. Because if the business can generate cash consistently, predictably, it can pay off debt, invest in growth, return capital to shareholders, and survive downturns. Earnings can be manipulated. Cash flow is harder to fake. You might wonder, why does this even happen? Why would a company report earnings it hasn't really earned? The answer is incentives. Executives get paid in stock options. Those options become more valuable when the stock price rises, and the stock price, well, it often reacts to earnings per share, not to cash flow. So what do? They dress up the earnings. They make the story look good, even if the wallet is empty. In the coming episodes, we'll go deeper. We'll show you how companies pull it off legally We'll explore examples where cash flow saved investors from disaster, and we'll show you what it looks like when the two align, when earnings and cash flow walk hand in hand. That's when you know you've found something real. But today, I want you to take away just one thing. Earnings tell a story. Cash flow tells the truth. And if you want to play the long game, you have to learn to read both, but trust the one that can't be massaged. This is part 1. Next time, we'll dive into how earnings can stay positive even when a company is dying inside, and how to spot the red flags before the market does. Stay sharp, stay curious, and most importantly, follow the cash. This is the Long Game Podcast. We're just getting started.
Welcome back to the Long Game Podcast. In part 1, we asked a simple but loaded question. Should you trust earnings or cash flow? Now in part 2, we dive deeper into the strange world where a company can look profitable on paper even when it's dying in reality. And this isn't rare. It happens more often than you'd think. Let's take a look at a company that nearly fooled the world, WeWork. Before the IPO collapse in 2019, WeWork had become one of the most hyped startups in the world. Valued at $47 billion, it claimed to be revolutionizing the way people worked. Its earnings presentations were packed with creative metrics, things like community-adjusted EBITDA. That's not a joke. They invented a number to strip out basically every real cost they had. Rent, build-outs, marketing, employee stock comp, all gone, so they could show fake profitability. Their net income was negative. Their cash flow was worse. But they told a beautiful story. They dressed it up. They dazzled investors with visionary slides, trendy buzzwords, and a charismatic CEO who walked barefoot into meetings and quoted yoga philosophy. But behind the image, the company was burning billions in cash. Every building they opened meant more expenses, and more leases, and more losses. They didn't have a cash-generating business. They had a cash-consuming engine, and it was running out of fuel. When SoftBank and other investors finally took a closer look, the truth sunk in. WeWork couldn't even go public. The IPO collapsed. The CEO was pushed out. The valuation dropped from $47 billion to around $8 billion almost overnight. All because people were seduced by the earnings narrative, not the cash reality. Let's bring it closer to home, to a company that still exists today and still stirs debate. Uber. For years, Uber reported losses, sometimes over $1 billion per quarter. But Wall Street still backed them. Why? Because they believed in the long-term vision. They believed Uber was buying market share, that someday the cash would come. And to some extent, that logic wasn't wrong. But here's what smart investors did. They didn't just look at net income, they looked at free cash flow. Because free cash flow tells you something raw. After the company does everything it needs to keep running, after paying employees, buying equipment, handling day-to-day operations, how much actual money is left? If it's negative, that company needs funding to stay alive. If it's positive, they can sustain themselves. Uber eventually began turning that corner. But it took years. And those who didn't watch the cash burn closely, they paid a price in early drawdowns. Now, here's a fascinating twist. There are also companies that get punished because their earnings look weak, but their cash flow is quietly strong. Take Adobe, for example. For years, when Adobe transitioned from selling packaged software to a cloud subscription model, their reported earnings dropped. Accounting rules said they couldn't recognize all that subscription revenue up front, even if the cash was already in the bank. So earnings declined. Investors got spooked. But the cash flow told a different story. Adobe was getting paid in advance and sitting on predictable, recurring revenue. It was building a subscription empire while earnings lagged behind. Those who watched the cash instead of the short-term earnings saw it for what it was, a transformation. And they were right. That's the danger in trusting earnings alone. Sometimes they make things look better than they are. Other times they make things look worse. Because earnings are based on timing, on accounting treatments, on assumptions. They're not always aligned with the actual health of the business. Cash flow is harder to disguise, and more often than not, it's the true signal buried beneath the noise. Of course, this doesn't mean you ignore earnings. That's not the message here. But it does mean that if you're serious about playing the long game, about investing in businesses, not just stock prices, then you have to treat cash flow like your compass. Earnings can point you in a direction, but cash flow tells you whether the road is paved or a cliff. In the next part, we'll look at how companies legally manipulate earnings without ever breaking the law, and why some of the world's biggest accounting scandals didn't need fraud to fool the markets, just smart use of timing. So stick around. This is the Long Game Podcast, and we're only at the beginning of understanding how to read the truth behind the numbers.
Welcome back to the Long Game Podcast. In the last two parts, we looked at how earnings can mislead you, sometimes with intention, sometimes just because of how the system is built. Today, let's go deeper into the machine itself, because here's something every investor needs to know. You don't need fraud to distort earnings. All you need is accounting. We're not talking about shady backroom deals or secret bank accounts. No, we're talking about decisions that are 100% legal, signed off by auditors, and built into the rules of the game. Let's begin with a simple truth. Earnings are based on accrual accounting. That means revenue is recorded when it's earned, not when the cash arrives. And expenses? They can be delayed, amortized, or spread out. This opens the door to something subtle, something powerful. A company can make small accounting choices that shift millions, even billions, from one period to another. And when those choices stack up, the illusion begins. Take GE, General Electric, once the most respected industrial company in America. For years, GE reported steady, predictable earnings. Quarter after quarter, they hit their targets almost like clockwork. Investors loved the consistency. Wall Street rewarded the stock. But here's what was happening under the surface. GE was quietly relying on aggressive accounting, particularly in its finance arm, GE Capital, to smooth out results. They used things like long-term service agreements, where they recognized revenue up front for deals that would stretch years into the future. They made optimistic assumptions about future profits, and when results didn't match expectations, they found ways to reclassify costs or sell assets to fill the gap. Nothing illegal, nothing that screamed fraud. But when the 2008 financial crisis hit, the whole structure wobbled, and eventually it collapsed. Investors realized they hadn't been watching a clean earnings story. They'd been watching carefully managed optics. And then there's WorldCom. Yes, this one did cross the line into fraud, but not before they showed how tempting the gray area can be. WorldCom capitalized costs that should have been expensed, turning normal operating expenses into assets. That made their earnings look far better than they were. For a while, it worked. The stock soared, but the cash flow told a different story. Eventually, it fell apart. Bernie Ebbers went to prison, but for a while, it all looked so clean. Here's the pattern. The earnings were crafted, the cash flow was neglected, and the reckoning came later. But let's not just focus on disaster. Even good companies, strong, ethical ones, can show very different pictures in their earnings and cash flow. Not because they're hiding anything, but because timing can distort reality. Take Salesforce, for example. As a cloud-based software company, Salesforce signs large subscription deals that get recognized over time. But the cash often comes up front, especially when customers pay annually. So you get this interesting inversion. The earnings grow slowly even when the cash surges. Now imagine the reverse. A company that ships a product today books the revenue immediately but won't get paid for 90 days. On paper, it looks like growth. But if you're not watching cash flow from operations, you'd miss the fact that receivables are piling up and real cash is missing. This is why smart investors track something called the quality of earnings. It's not just about how big the earnings are. It's about where they're coming from, how stable they are, and whether they're backed by cash. You can ask questions like, are earnings rising because the company is truly growing? Or because they changed their depreciation schedule? Did they suddenly capitalize more costs this quarter? Or pull forward revenue from next year? These are small decisions, but together they build the story investors believe. And in a world where algorithms trade headlines and investors react to earnings per share within seconds, the temptation to polish the story grows stronger every year. But here's the antidote. It's not cynicism. It's discipline. Discipline to read the cash flow statement. Discipline to ask, how much of this profit is real? Discipline to look not just at net income, but at operating cash flow, capital expenditures, and free cash flow. Because in the long run, cash flow is gravity. You can defy it for a while, but it always pulls you back. In the next part, we'll shift focus. Now that we've seen how earnings can be shaped, we'll learn how to read a cash flow statement like an investor, not an accountant. You'll see how to tell whether a business is truly healthy or simply reporting a good story. Because this is the long game. And knowing how to read the truth behind the numbers is how you win it.
Welcome back to the Long Game Podcast. By now, you've probably started to feel it, that itch behind the numbers, that quiet realization that not all profits are created equal, that some companies look rich on paper but can't pay their bills in reality. So, let's take the next step. In this episode, we're going to strip down the cash flow statement, not like an accountant would, but like an investor must. Because reading this statement isn't about checking boxes, it's about listening to the heartbeat of the business. Let's start at the top. The cash flow statement is divided into 3 parts, but the first one is the most crucial: cash flow from operating activities. This section tells you whether the company's core business, its actual day-to-day operations, is bringing in cash or consuming it. This is the oxygen line. If this number is consistently negative, you're looking at a business that might need external support just to stay alive. If it's consistently positive, that's a company that can fund itself even in a storm. Let's look at a real-world example. Apple. In 2023, Apple generated over $110 billion in operating cash flow. That's not revenue. That's not profit. That's real, bankable cash from selling products, collecting payments, and running the business. It's the kind of number that tells you this company doesn't need to beg. It doesn't need to borrow. It prints cash. And that's why Apple has the power to return capital to shareholders, invest in R&D, and still sit on a mountain of reserves. But the story doesn't end there. Right below that, you'll find cash flow from investing activities. This part is a little trickier. It includes purchases of property, equipment, acquisitions of other companies, or sales of investments. In a vacuum, a negative number here isn't bad. In fact, it can be a great sign. It might mean the company is investing in its future. Take Tesla, for example. For years, Tesla reported negative investing cash flows because they were building gigafactories, buying robots, and expanding production capacity. That's not weakness, that's growth. But again, you only see that if you know what you're looking for. Now move to the third section, cash flow from financing activities. This shows you how the company is funding itself. Are they borrowing money, paying off debt, issuing stock, buying back shares, or paying dividends? In other words, how are they managing their relationship with the outside world? Let's say you notice a company issuing tons of new stock every quarter. Sure, that might bring in cash, but it's also diluting your ownership. If operating cash flow is negative and the only thing keeping the lights on is new investor money, you're not looking at a business, you're looking at a bonfire fueled by hope. On the flip side, look at Microsoft. For years, it's generated so much cash that it's returned billions to shareholders through buybacks and dividends, all without sacrificing growth. That's a business with options. That's a fortress. Now here's the part that really matters. The line at the bottom. Net change in cash. This is the ultimate summary. After everything, operations, investments, financing, did the company end the quarter with more cash or less? You'd be shocked how many profitable companies actually end up burning cash quarter after quarter. So, how do you read all this together? First, look for consistency. One great quarter doesn't mean much, but 5 years of strong, positive operating cash flow? That means something. Second, compare it to net income. If a company reports $1 billion in net income but only brings in $200 million in operating cash flow, ask why. Is it a one-time thing or a red flag? Third, calculate free cash flow. This is the money left after capital expenditures. It's what the company has to reward shareholders or reinvest freely. Some of the best businesses in the world are judged not by net income, but by free cash flow. Take Facebook, Meta. For years, they didn't pay dividends, but their free cash flow was massive. It allowed them to buy Instagram, WhatsApp, Oculus, moves that shaped the future of the company. No matter how polished the earnings call is, no matter how shiny the PowerPoint slides, the cash flow statement tells the real story. And the best investors? They don't just listen to what the company says, they listen to what the cash says. Because cash doesn't need spin. In the next episode, we'll go deeper into the red flags, patterns that show up when a company's earnings and cash start to diverge dangerously. We'll look at real-world examples where cash flow warned investors long before disaster hit, and how you can learn to spot those signals before the crowd does. Until then, trust the number that doesn't lie. This is the Long Game Podcast, and this is how you learn to read between the lines.
Welcome back to the Long Game Podcast. So far, we've learned that cash flow is the truth teller, that it reveals what earnings often hide. But today, we're going to look at something even more powerful and more dangerous. We're going to talk about red flags. Because sometimes, cash flow doesn't just whisper truth, it screams warnings. And if you know how to listen, you can hear those alarms before everyone else does. Let's begin with a company you might not remember unless you lost money in it. Valeant Pharmaceuticals. At its peak, in 2015, Valeant was a Wall Street darling. Its earnings were booming. Analysts loved its model: acquire other companies, cut costs, boost margins. On paper, it looked like a machine of pure profit. But something strange was happening. While earnings looked fantastic, operating cash flow wasn't keeping up. Receivables were growing. Working capital was ballooning. The company started relying more and more on financing, debt in particular, to keep expanding. That was the red flag. A business that generates real value over time should produce cash from its operations. But Valiant wasn't. It was creating earnings with accounting, not cash. Meanwhile, it was using debt to fuel acquisitions and plug holes. Then came the collapse. When regulators started asking questions, when scrutiny increased, the whole house of cards fell. Valiant lost more than 90% of its market cap. Investors who followed the earnings missed the signs. Those who watched the cash flow, they had warnings long before the headlines broke. Here's the pattern. When net income is rising, but operating cash flow is flat or worse, falling, that's a divergence. And divergence is where danger begins. Take another case. Sun Edison, once the largest renewable energy developer in the world. On paper, it was a dream. Huge growth, green energy, big earning potential. But in reality, Sun Edison was spending more than it made. Its free cash flow was deeply negative. It kept borrowing to grow faster, acquiring companies with the hope of someday becoming profitable. Sound familiar? The strategy worked until it didn't. In 2016, Sun Edison filed for bankruptcy. The balance sheet cracked, the cash dried up, and the market watched, stunned. But here's the truth. If you were watching the cash flow statement, you wouldn't have been stunned. You would have seen it coming. This is why great investors treat cash like a detective tool. Because red flags aren't always dramatic. Sometimes they're subtle. Maybe inventory is growing faster than revenue. That could mean the company is building up products it can't sell. Maybe accounts receivable is rising sharply. That might mean the company is booking revenue it hasn't collected, possibly never will. Maybe capital expenditures suddenly drop. That might seem efficient, until you realize they're under-investing in future growth just to boost free cash flow temporarily. These are the small cracks that become collapse. Even strong companies sometimes drift into red flag territory. The question is it temporary or is it systemic? Let's take Peloton as a modern example. During the early pandemic, Peloton exploded. Sales surged, earnings turned positive, the stock went parabolic. But under the surface, operating cash flow was volatile. Inventory ballooned. Customer acquisition costs rose. And when the world reopened, sales stalled, but costs didn't. Cash flow turned negative. And the stock? It cratered. Again, the cash knew before the headlines did. So what can you, as a long-game investor, do? First, make it a habit to look at cash flow from operations every quarter. Compare it to net income. Ask, are they moving in sync or pulling apart? Second, track working capital changes. Are receivables, inventories, or payables swinging wildly? That's where early signs live. Third, watch free cash flow over time. Is it growing predictably or bouncing around with no pattern? And finally, question the story. If a company says it's profitable but can't pay its bills without borrowing, something's off. Because real businesses don't just survive on accounting. They survive on cash. In the next part, we'll shift focus from red flags to gold mines. We'll explore the signs of a truly healthy business, one that earnings and cash flow move together, one that doesn't just tell a good story, but backs it up with hard currency. Because the best companies don't just make money, they make cash. This is the Long Game Podcast, and we're just getting to the good part.
Welcome back to the Long Game Podcast. So far,
We've looked at the warnings, the companies where earnings and cash flow fall out of sync, and the pain that follows. But today, let's flip the lens. Let's look at what great companies do. Because when a business is truly healthy, something beautiful happens. Earnings and cash flow walk in step. They reinforce each other. They speak the same truth. And when you find that alignment, that harmony between the story told and the cash collected, you may just be looking at a business built to last. Let's begin with a company everyone knows, Visa. Visa doesn't make physical products. It doesn't carry inventory. It doesn't build factories. What it does is process transactions, billions of them. Every time someone swipes a card, Visa takes a tiny fee. It's invisible to most people, but it adds up fast. Now, here's the beauty. Visa's earnings are impressive, but its operating cash flow is almost identical to those earnings. Why? Because it collects cash fast. It has minimal capital expenses, and it scales effortlessly. This is a classic example of a high-margin, high-cash flow business. It doesn't need accounting tricks. It doesn't need debt to survive. It simply earns and keeps real money. Now, compare that to another titan, Procter & Gamble. P&G sells everyday items, shampoo, detergent, baby wipes. Nothing flashy, but what makes them powerful is consistency. Their net income has grown steadily over the years, and so has their cash flow. They're not just profitable, they're predictable. And that predictability turns into shareholder dividends, stock buybacks, and long-term trust. You see, great companies don't just report profit, they convert it. They don't just chase sales, they turn those sales into cash. Let's look at one more, Costco. At first glance, Costco seems like an average retailer. Low margins, warehouse stores. Nothing exciting. But dig deeper. Costco generates positive cash flow from operations year after year. It turns inventory quickly. It collects cash from customers upfront while often paying suppliers later, a model that creates built-in cash efficiency. And even though it reports earnings that aren't explosive, the underlying cash tells a story of quiet, disciplined excellence. Costco doesn't try to impress Wall Street. It just runs a tight ship, and the numbers show it. So, what do these companies have in common? First, consistency. They don't just have good quarters, they have good decades. Their cash flows aren't a roller coaster, they're a river. Second, alignment. Their net income and operating cash flow generally move together. That tells you the earnings aren't being inflated or distorted. Third, capital efficiency. They don't waste money. They don't build things they don't need. They reinvest wisely, and their return on capital stays high. Fourth, resilience. When downturns come, and they always do, these businesses still generate cash, maybe less than before, but never none. They stay liquid. They stay strong. And finally, transparency. Their financials are straightforward. You don't need a forensic accountant to understand how they make money. Their business models are understandable, and their cash flow proves it. So, if you're an investor, what should you look for? Start with multi-year comparisons. Look at 5 or 10 years of cash flow and earnings. Are they moving in sync? Check the cash conversion ratio, operating cash flow divided by net income. If it's consistently below 1, that could mean trouble. If it's over 1, that might signal quality. Review capital expenditures. Are they reinvesting wisely or throwing money at unproven ideas? Examine free cash flow trends.
Has it grown over time, even when the economy dips? Because in the end, a great business does something magical. It tells the truth in every language. Revenue, profit, cash flow. They all say the same thing. We don't just grow, we endure. In the final part of this series, we'll bring everything together. We'll explore how to build your own framework for evaluating businesses, one that balances earnings, cash flow, and context. Because the answer to our original question isn't just cash or earnings, it's wisdom, the kind that comes from understanding both and knowing when to lean on which. This is the Long Game Podcast. And next, we close the loop.
Welcome back, for one last time, to the Long Game Podcast. Over the last 6 parts, we've pulled apart one of the most misunderstood questions in investing. Should you trust earnings or cash flow? And now, here in part 7, it's time to bring everything together. The truth, as it turns out, isn't black or white. It isn't only earnings or only cash. It's deeper than that. It's about learning to read financials the way you'd read a novel, not just looking at the words on the page, but understanding the author's intent, the structure, the subtext, the truth behind the telling. So, let's pause and reflect. Earnings are useful. They give us a snapshot. They show how well a company manages its accounting, its taxes, its operations. They're clean, structured, and comparable. But they can also be manipulated, not always out of malice, but sometimes out of necessity, pressure, or short-term thinking. Cash flow, on the other hand, is raw. It doesn't care about optics. It's the ultimate litmus test. Because while profits can be moved around, reclassified, or deferred, cash is either in the bank or it's not. But here's where it gets interesting. You need both. If a company reports strong earnings and strong operating cash flow, you're likely looking at a healthy business. If earnings are high but cash flow is weak, start digging. If cash flow is strong but earnings are low, ask why. Is the company being overly conservative in its accounting? Are there non-cash charges hiding its real strength? If both are weak, move on. But beyond numbers, here's the mindset I want you to take with you. Investing is not a game of precision. It's a game of pattern recognition. And the best investors aren't always the ones who can recite formulas. They're the ones who can feel when something is off, when a company's financials don't match its story, when the numbers don't walk in step with the reality. They look for businesses with soul, with purpose, with discipline. And more often than not, those businesses are the ones where the cash flow is quietly strong. Because real greatness doesn't scream, it compounds quietly. Think about some of the companies we've talked about. Apple, Microsoft, Costco, Visa. They didn't explode overnight. They built, they endured, and the cash, the hard, tangible oxygen of business was always there, quietly fueling the fire. So the next time you pick up an annual report, don't start with the cover. Don't start with the CEO's letter. Start with the cash flow statement. Read it line by line. Trace the movement of money. Ask where it came from, where it went, and whether the story makes sense. Because in the long game, numbers can lie, but cash can't. If you take nothing else from this series, let it be this. Don't just listen to what a company says. Watch what it does and follow the money. Because trust in business, just like trust in people, is earned not through promises, but through action. And cash flow is action made visible. This is how you see clearly.
This is how you invest wisely. This is how you win, not today, not tomorrow, but over decades. This is the Long Game Podcast. Thank you for walking this journey with us. And until next time, stay patient, stay curious, and always follow the cash.